you can hear me okay through my microphone, just give me a little chat and we'll get going here. Fantastic, fantastic. So as you can see, I'm sharing with you on my screen just a big slide that says a supercharged 6% protocol variant or put protected call writing on leaps. Anybody ever do something similar to that? If you do, just type a little yes inside that chat box. Fantastic, fantastic. A few of you have done it. I guess more importantly, who has not given it a try? Just give me a little no inside the chat box. By the way, I love these webinars to be interactive, so I might ask you to say yes or no. So I feel like when we're interactive, instead of me just speaking and showing you stuff, I feel like you're going to get a lot more. And my webinars tend to be very much on the training side, so I hope, I want you to go in here with an open mind. Have a piece of paper, take a couple notes. In fact, I've been known, people, let me be honest with you, you might want to have 3 or 4 sheets of paper because I want you to walk away with some things that you could actually try, at least in your paper trading log, in the next couple of days. Of course, one thing I got, and don't worry, I'm not going to be showing you a million slides. I'm going to actually be showing you my screen. Excuse me. By the way, how many of you with a yes or a no inside the chat box, how many of you have actually heard of me before? AJ Brown with Trading Trainer. Started in 2003. Okay, cool. Some of you have. Cool. Well, first thing I have to do, of course, so we don't have anybody with crazy black helicopters. Should you want, the thing that I've been working on for quite a while now is called the 6% protocol. So I just opened up a browser and I'm just visiting 6percentprotocol.com. There's a bunch of different variations that you could go to. And I always want to put down, of course, what my lawyer tells me I have to do is make sure you know that there's risk involved with doing any sort of trading. And so if you want to check out the actual legalese involved with what I'm talking about today, so that you know that, of course, you could lose all your money if you try any sort of investing, but that doesn't mean you shouldn't. That means you should just be smart about it. You can go to the 6% protocol, and down at the bottom we have the investment risk warning and financial disclaimer. All right, now that that's to one side, let's get busy. The 6% protocol is a program that I've been using with the folks that follow along with me. I'm going to go back to my slide here. And this is a variant I'm going to be talking about. And what I'd like to actually push through is beginning with a certain concept, because a lot of people say, well, 6%, what does that mean? What is it all about? So let's run through a quick little simulation here. Some of you have already been through this, so just play along with me. Those of you that haven't, think through this next question. If I were to give you, because this is going to tell me whether or not you've really got the right mindset for being into the whole investing world. If I were to give you $50,000 today, or give you the option to have a penny that doubles every day for a month, which would you take? Think about that a second. I'm going to run through a little scenario here. So we're already up to day 7. Only got 64 cents. Up to day 10, we're up to $5.12. Just doubling that penny every day. Starting to get exciting by around day 20, but nowhere near the $50,000 I would have handed you, and you're already 2/3 of the way through the month. How many of you with the show of hands understand that? But now here's where it gets kind of exciting. Around day 24, I just beat my $50,000. On day 24, by starting with a penny and doubling it every day, I'm at $83,886.08. And it keeps going from there till, of course, at the end of the month, $21,474,836.48. It's attributed to Einstein. Compound interest is the most powerful force in the universe. Not sure if he really said that, but everybody points to him as saying that. That's why we have to focus on 6%. If you put the max amount into a Roth IRA, tax-free investment fund, and you just focus on 6% increase per month on that amount, the magic component around 6% is that if you compound that monthly, in 1 year you've doubled your money. So depending on how old you are, let's just use a round number of $5,000. It could be a little bit more if you're a little bit on the higher side in age. Put 5,000 at the end of that year. If you focused on the 6%, it's really only grown to $10,000. Add another 5, so that at the beginning of year 2 we've got 15. 6%. Focus on the 6% number. With options trading, especially with the 6% protocol, that's doable. That's doable without having to be in front of the computer nonstop every day. 6%, 6%, 6%. 12 months later, you're up at 30. We can add another 5. Brings us to 35. At the end of year 3, we're at 70. Add another 5. That brings us to 75. At the end of year 4, we're at 150. Probably at the end of year 4, you don't have to add the 5 anymore. You could, but it becomes insignificant. A lot of the folks that have been working with me, the 6% protocol has been a project of mine since about 2008. When I was a kid, I'm in my mid-40s. When I was a kid, being a millionaire was what was on TV, you know, Robin Leach in the 90s talking about being a millionaire and all that good stuff. But I have to be honest, here it is 2017. Being a millionaire is a dime a dozen. Doesn't get you very far. How many with the show of hands agree with that? The screen's not updating right yet, Abe. Now, you really, if you want to be set for life, set your family for life, it's got to be 10 million. I have some folks that have been just following the 6% protocol along with me, and they're way past that number. What's nice about that number is if you take $10 million or so and you put it into a successful mutual fund, an ETF, even into gold or Bitcoin. Let's take a mutual fund that only pays 3% a year. $10 million would give you $300,000. Could you live on $300,000 a year, you and your family? I know my family could. Yes, we're talking about a tax-free Roth account is what a lot of my folks have been doing then. So great. 6%. What that winds up doing for us is pushing us to a place where we could actually take that money from even a simple investment like a mutual fund and rolling it back in there, and then you have perpetual growth. Because not everybody needs $300,000 or so to live on. So that's the goal. But now, a lot of the folks have been able to attain their goals faster because they've been using a variant. And that's what I wanted to talk to you about today. So if you, and I'm going to stop sharing my slides here for a second. I'm going to just bring up a browser. I'm going to just start showing you things. If I go to login.tradingtrainer.com, which is our web portal, this is where the 6% protocol lives. We have all of our tutorials there that show people how to use it in the main screener. What this screener does is it goes through all the stocks and all the option chains out there and looks for the most probable candidates using a 12-step algorithm that we could do buy writes, write covered calls, do put protected covered calls, about 7 different trading strategies. And we can compare them quickly just using a buy write numbers to see which ones we'd want to pursue further. The reason why we want to do that, of course, and we run this screener at the end of every trading day. The reason why we want to know that is because, as you can see here, just since the expiration on April 21st of the last option series, there's probably at least 25 or 30 candidates that we could be doing deep dives on. You want to verify that these are the candidates you'd want to put your money into. But I have to admit that I'm very much a lazy trader. That means once I got my trade in place, I do not want to spend my whole life in front of the computer. I like to put as little energy as possible. I like to make the biggest returns. For me, I have to be completely honest to see if we're all on the same page here. I'm going to go ahead and open up here a little note-taking. But for me, time and location freedom is what freedom's all about. Does that make sense? If that makes sense. Go ahead and type a yes into the chat area. I don't, now that I'm in my mid-40s, I realize that money is important, but that I can get it whenever I want. What I don't want is somebody offering me an amount of money for one of my hours. In other words, I don't want to get paid hourly. If you go to my website, you'll see that if you wanted to have an 8-hour coaching program with me, the price of that is $40,000. And I'll tell you why I put it at $40,000. Because up until 2015, it was $25,000. And for some reason in 2015, 8 people paid me $25,000 to spend 8 one-hour sessions with them. So I had to raise the price to $40,000. And even at $40,000, we had 2 people already in 2017 pay me that amount to spend 8 1-hours. In other words, I'm trying to raise the price to the point where people won't do that. And the reason is because I can't get those hours back. I can get money. I've seen money come and go, especially in the investing world. But I cannot, every time I sell one of my hours, I can't get it back. So I'm big about not wanting to sell my time. And the other thing is, and Fausto knows this, a lot of people know this, I have a tendency to get wanderlust. And so I'll just buy myself a plane ticket. And so long as I have internet connection, I can check on my investments. You'll find me living 6 months in Italy, going up to Canada, checking it out just on a whim. Going to go down to Guatemala in July for a good few weeks. I just like to go. I don't want somebody telling me I have to be in a certain place at a certain time. So that's more important to me. And the last thing I want to do is be stuck between 9:30 Eastern and 4 o'clock Eastern every day in front of a computer. Does that make sense? Who's actually in the same boat as me? If that's you, just say yes. And do we have anybody on the line who actually does want to have a job as a trader? That's your thing. Because what I'm going to be showing you might not be for you. All right, cool. So, for those of you that are, let me ask this. How many of you are big into options? Options on equities, meaning indexes, stocks, ETFs. I might go a little bit overboard here, and I got only a few minutes. I don't want to waste your whole afternoon here, but I always look at option trading strategies as profit and loss diagrams, because that's how you can keep them. There's 27 different option trading strategies, and that's how you can keep them all straight. This is a typical covered call writing strategy. The whole thing behind a covered call, in theory, is that you buy a stock. So if I were to draw a profit and loss diagram, and I'm trying to with my shaky hand, this is the profit and loss diagram for a stock. Every time the stock appreciates by $1, you profit by $1. The minute we sell a call against that, we make an instant dividend and create a profit buffer. Basically, we move our profit and loss diagram over by the amount of our premium. And so we build for us this instant dividend. Now, nothing comes for free, so there's a certain point where, because we did that, we hit a max profit. Whereas if we stayed long the stock, we would continue to appreciate. So the trick is to play in a zone that gives us the profit from the wasting asset, the option, and doesn't get us knocked out. And that's what the 6% protocol in its 12-point algorithm is looking for, those combinations, the screener. Once you've got those up, I want to give you a list. Everybody got their notepad ready? I want to give you 10 different ways that you can test to make sure you've got a candidate you're interested in pursuing. One that would be perfect for doing any sort of premium type trade against it, but especially the variant I'm going to show you, which is not a covered call, it's more of a diagonal trade, and there's a lot of profit in it. So the first test we want to look at, and this is a lot of technical, some of it's quantitative analysis, a little bit of it's just researching the underlying. The first test I want you to do is, let's pull on our Bollinger Bands. Normal 20-day setting, and look at the width. I'm going to go ahead and on my tool here, I'm going to go ahead and log into, so I can show you this. I'm going to go ahead and let's actually do it this way. We have charting built into our learning community here and our web portal, so I'm just going to use it. But you can use any charting that comes with your brokerage or any charting that you want to free charting out there. So let's get the Bollinger Bands onto our chart. I'm going to pull up a chart that I've been looking to do this on for a while, and that's Caterpillar. Hold on one moment. Log in here. Pull up our chart on Caterpillar. So what I'm looking for with my Bollinger Bands is the Bollinger Band width, and I don't want it to be at a point when I pull this strategy of it being extremely compressed. And some of you that have some experience with analysis will see as we get through these 10 tests what it is I'm actually looking for. You'll probably be able to reverse engineer what it is I'm actually looking for. But just in our notes here, Bollinger Bands, consistent, not converging with. Number two, I want to look at the count of candlestick bodies since the last time a body has been outside of the Bollinger Bands. I call that my candlestick count. Now, I don't care so much about the wicks. I want to look at the bodies. So, for instance, here we've got 1, 2, 3, 4, 5, 6, 7, 8, and then the ninth body was across the Bollinger Band, the 20-day Bollinger Band. So typically I like to see this number being greater than 20. The larger, the better. Number three, I like to quickly take a look at my EMAs, exponential moving averages. I like to look at the 5, the 10, and the 20. And I like to see whether or not they're converging. Now let's use some free charting tools. I know you've got this built into a lot of your customized charting, but for those of you that are just using free off the internet stuff, let's go ahead and you can go to stockcharts.com or TradingView, one of those free ones. We'll put in Caterpillar and we'll look at those exponential moving averages that I'm talking about. All we've got to do over here, make it nice and big so that you don't have to squint. Then we'll just come over here and we'll do, like I said, exponential moving average, exponential moving average, exponential moving average, 5, 10, and 20. We'll go ahead and give ourselves a line here. Or actually, we can make this invisible. That'll be even better. So that when we look at this thing, you can see the exponential moving averages. I'll go ahead and zoom in for you. And what I don't want to see, again, is any of the converging. Okay? Converging leads me to the confidence that this thing is not going to stay calm going sideways, which we want it to. Instead, it's going to be interested in some future volatility. That's not what I want. I want it to simply be going back and forth, crossing, kind of this little ongoing cross, 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 but I don't want to have it where it's on top of each other. Again, no converging. The next thing I like to look at, I call it my naked chart. Either candles or open, high, low, close bar, no indicators. Sometimes I even drop the volume off of a normal price and volume chart. And I look at these things and I quickly characterize, is this a sideways mover? Is this a trender? Is this something that has no sort of pattern at all to it? I want a sideways mover. I don't want a trender. Am I going too fast? How many of you with the show of hands am I going too fast? Okay. Sideways channeling. Number 6, or number 5, I'm sorry. I want to see clearly tested lines of support and resistance. We know what support and resistance are, right? Support and resistance is where people have seen price action hit a spot and not go higher. And so they call up their broker or they access their electronic terminal and they say, I've been taught my whole life to buy low and sell high. And so the next time we get up to a range like this, since it hasn't gone higher than that before, that's where I'm going to sell high. I'm going to put a limit order to sell or to sell to open at that price action. Same thing with support. Gosh, I've never seen price go below this level before. So I've been taught my whole life to buy low and sell high. So I'm going to put limit orders down here in order to buy to open whenever I get to this range. And that's what creates support and resistance, those limit orders. Because as price approaches that zone where limit orders have been waiting for them, we all know from our Economics 101 classes that when there's a lot of buying, that makes price increase. And then when it hits that zone of resistance where a lot of limit orders are in place, and there's a lot of selling that automatically happens, we create a self-fulfilling prophecy. We create our own levels of support and resistance. And the more times they're tested, the more people jump on board. You see how that would make a downward and an upward spiral? How many with the show of hands? Little type in the chat box, say yes. So we would like to look over here and see exactly when we would get the various tests and how long we've been testing in our sideways channel. Something exciting has to happen, like just happened at the end of April, to pop us out of that channel. Number 6, we're going to look at support and resistance from a million different ways. So number 6, I'm going to look at what's called a point and figure chart. I can do that again over at our friends with their free offering at stockcharts.com, or you can use whatever point and figure. By the way, how many with the show of hands or how many with the yes inside the chat box have used point and figure charts before? And I guess I want to ask the opposite question. Who hasn't used point and figure charts before? Ty, give me a no. I didn't discover them. For myself, I discovered point and figure charts in 2006. And this was like all of a sudden having the blinders lifted off of me. So for those of you that aren't familiar with point and figure charts, versus price and volume charts, point and figure charts increment a column every time there's a reversal, instead of on a set time frame. So you won't get a movement to the right unless you've had a reversal. And you can see clearly where those reversals happen. A column of price, if it's X's, means that we've had an upward move. And then if you hit a top, a reversal, you then have a column that's a downward move. And then when you hit a bottom, upward move. Can you see my cursor tracing? Downward move, upward move. What's beautiful here is you can see exactly where all the reversals occur. Very, very easily. With point and figure charts, they will go ahead and let you know, just by reference, when each month starts. So for instance, the month of January started right here, where the 1 is. And it went up during the month of January, hit a top, reversed down. Then you had February start. February started a little bit down, reversed at a bottom, came back up, went back down, came back up. March started. March was mostly a down month, and then it popped back up, went back down. April, and now we just started May. May has been a down month for Caterpillar. Of course, we don't have we have 12 months that we measure our year in. And so after 8 being August and 9 being September, they'll go ahead and mark October with an A, November with a B, December with a C. So in November, we went a little bit down, and then all of November was a huge appreciating month for Caterpillar. And then as soon as December happened, we hit a top, went back down, kind of went back up, and we ended or began December just about where we began January and got into this sideways movement. In other words, we can really see where the tops and the bottoms, where the reversals are, where is the clear lines of support and resistance by looking at our point and figure chart. And that's just the beginning. If you ever have a chance to really get into point and figure charts, it'll be like it happened for me, where the lights went on. It's like, oh my gosh, I've been blind until now. Let's also add something called price by volume. Price by volume allows us to see how much trading, red being the buying, black being the selling, occurred at these various price points. Lets us double check if that truly is a source of support and resistance. There has been a lot of trading where the reversal occurs, and we're going to have some good support and resistance. I have somebody here that says, are you using daily charts? Again, point and figure charts are not measured by time. They're measured by price action. So some months, for instance, like if you look over here, January to February, there was very little price action that occurred. And there's other months where you have a lot of price action. that makes sense. So let's add that to our list. Price by volume. And what's really nice is you can take these 10 criteria, these 10 little mini tests, and you can, after a bit of repetition, oh, it says my screen is blank. Good. Let me bring it back. Hold on. After a little bit of repetition, you can quickly evaluate these 10 little tests I'm giving you in under 3 or 4 minutes. Okay. You just have to eyeball. Let's keep going. Number 8, I want to do something called a fractal pattern analysis. Back to my regular price by volume chart. Here we are looking at daily 6-month charts. I also want to look at weekly 2-year charts and see if I can see the same sort of sideways movement in the different time period charts. Weekly, how about monthly 10-year? When I look at Caterpillar over the last 10 years, I can clearly see that Caterpillar trades in a range between about, what, $73 and $110. And that gives me some confidence that I can trade this strategy against this candidate. So we call that fractal patterns. In fact, you could go the other way as well. You could look at 30-minute bars and look at about 2 or 3 days. But the main ones that I use, let's bring up our notepad, is daily 6 months, weekly 2-year, and monthly 10-year. You're looking for repeating pattern. Okay. Let's go on to 9. 9's one of my favorite. How many of you are a little bit good at math? You want to see a cool little math formula that could give you a lot of information? Yeah? I call it the channel width over average channel price ratio. Let me show you how to calculate that. So let's go back to our 6-month daily chart. And we've been looking at this level here with resistance down here at, let's say, $92.25. Or support down at $92.25. Resistance up here at $98.75. So support, $92.25. Resistance, $98.75. So my channel width In other words, what's the distance between the high and the low of price? I subtract my support from my resistance. I get $6.50. Who doesn't see how I got $6.50? Okay. Now we also want to do the average channel price. This is the average, I don't know any other way to say it than the average channel price. So instead of subtracting one from the other, I'm going to add one to the other and divide by 2. So the average channel price of this channel is $95.50. And now I'm going to compare the ratio. So $6.50 divided by $95.50. This ratio, which for us comes out to 6.8%, can tell us whether we're getting to the point where a pending breakout can occur, which would not do well with this option trading strategy. So ideally, we want this thing to be somewhere between 10% and 20%. 6.8 is a little bit, that would give me the heebie-jeebies. Anything below 5, I wouldn't touch with a 10-foot pole. Great test. Last test, number 10, is to just check if we have dividends. So if you look at these tests, test number 1, test number 3, test number 9 for sure, these tests are telling me whether or not I've got something that's getting ready to give me a surprise price action move. Test number 2, test number 4, 5, 6, 7, even 8 are telling me that I've got very heavy support and resistance no matter which way I look at it. That's going to keep me bound going sideways, which makes this 6% protocol strategy operate like a well-tuned money machine. Number 10 is actually knowing that investors are getting dividends. They're not going to put pressure on a company, whether it be pressure in the boardroom or pressure by buying and selling pressure. They're not going to put pressure on a company to appreciate as much as if the company didn't give dividends, right? If you're getting paid quarterly by owning a stock, who cares what the stock price does? So we look to see if there's dividends. So that's kind of a qualitative measurement. Now, no one stock is going to score perfectly on all 10 of these tests, but again, you can get very good through practice at using these 10 tests to get your evaluation time down to just a couple of minutes, and then you can use it for comparison. The one that gets the most tests met, and a lot of these tests have kind of a gray area, so the ones that have the 10 tests met the best, that's the one you would pursue. Fran asks about earnings. Earnings isn't really going to be confusing us when it comes to is this stock going to continue going sideways or not. You can see that Caterpillar had some nice earnings, and look what's happening. It's popping right back down into that channel. Now, when we get to actually employing the strategy, yes, you're going to want to know when earnings is and navigate around that event. But as far as finding the candidates we want to pursue, that's not one of our 10. Great question. And also, I will stay on once I'm done with my little lesson here, and I will stay on as people have questions, and I'll just continue to answer till there's no questions left. So if you have a question, you may want to, it's okay to throw it into the chat box now, but you may want to have it be part of our Q&A session, and that way other people, if they've had enough of me, can go on with their day. All right, So we figured out which candidates we want to try. We're just going to use Caterpillar as an example. But if we were to do a normal covered call writing on, say, for instance, Caterpillar, let me come over here. Actually, I want to keep that nice and big. I'm going to come back to my web portal. I'm going to come over here. I've got the option chains. We get our option chain data directly from the Chicago Board of Options Exchange. So we'll just pull up Caterpillar. So a normal covered call would be where we would go and buy the stock at whatever closing price it's at. 99.29 is this one. Let me bring back my notepad so you can follow along. So I'm going to use some, I say buy to open, because we can buy to close at the end of a shorting. So we want to go long. Buy to open Caterpillar, and we would do that by going at 99.29. And then we could sell the at the money near term option. You can do it with the weeklies if you want to make a dividend every week. I like to do it monthly just because there's a lot more liquidity in the monthly options. And because I already told you I'm sort of a lazy guy. So I like to do the economics once a month. And then that's about it. All right. So if we go to our monthly option here and we look at the at the money flavor, it's trading somewhere between about 85, 97 cents. So if I want to sell this back, make a little instant dividend is what I call it. It also gives me a profit buffer. So if the candidate goes down by a certain amount, I'm still making money. I could put an order in roughly at about 90, 91 cents. So I'm going to sell to open the Caterpillar May 100 call. Now, truth be told, when I actually do this, I look at my channel. This is what, if we're doing this like scenario test as we're doing today, it's called a buy right, which means I buy the stock and then immediately sell the call. That's not how I would do it in practice. How I would do it in practice would be to take my time and buy the stock as it approaches this level of support, or even better, after it's tested support and it's on its way back up. And then I would be timing the selling of my call options whenever I'm at the top. So I spend a little bit more time. I visit the stock maybe once or twice a week until I've bought the stock low, sold the call option high. But for today, we'll do the buy right. And just so you know, when you do time it the way I just described, and you don't have to be a rocket scientist about it, just if you're in the area, the zone of support, and if you're in the area of the resistance, you'll do very well. You could actually double, if not triple, the returns, and that means you're also going to have a commensurate reduction in the risk. And I'm not going to spend much time talking about that any more than I just did, simply because, well, you saw how many tutorial videos are in the 6% protocol. I could talk about that for a while. So if you look at this now and we do our math, 99.29 minus 91 cents, our cost basis on this guy is now $98.38. If we were to get called out at $100, that means we would make a profit of $1.62. And yes, there are commissions involved. And so $1.62 over our cost basis, May 19th, which is approximately 10 days away, 8 trading days away, and I'd walk away with 1.6% returns. Nowhere near the 6% I like. If I timed it, like I said, we could double if not triple that. That could bring us all the way up to maybe 5%. Still not good enough for me. So what can we do? And this is where this variant comes in. Very exciting. I want to get the same returns. I still want to make this 91 cents, but I don't want to pay 99.29. So there's something we can do with options. When you get into options, you start to learn how you can optimize different components of the option. Option, of course, is a derivative designed to hedge an underlying symbol's risk. But an option's price is influenced, not just the underlying symbol price. It can be influenced by the buying and selling pressure on the option itself. The buying pressure would go up if people are using that option as a hedge. They think something's coming up, like an earnings report. And so they'll buy a whole bunch of the options, causing the price to appreciate. Or they'll sell them when they no longer think that the underlying symbol is going to get squirrely on them, and that'll make the option price drop. We call that implied volatility, by the way. It also will lose its price based on how many days before expiration. Options are called wasting assets. And of course, it is completely influenced by what the price of the underlying symbol is. But you can manipulate these options by choosing different strategies, as well as what their strike price is and what their expiration date is. And you can tune these things like a car. You can tune it like we can with a car in order to be like luxury and kind of press on the gas pedal and it comes to life. Or you can make it sport, meaning it's very reactive. You can optimize these options to respond the way you want them to. That's why when I talk about being an options trader, it's not a question. When you talk to folks that are only focused on, for instance, Forex or stocks or commodities, you have like the option to go long or go short. So it becomes for you more of a question of timing of your trades and also a question of yes or no, do I do this trade? For me, I have 27 different strategies and I can tune them almost infinitely different ways. And so for me, it's less of a question of timing. There is some timing, but I can be a little bit more sloppy. And it's less of a question of do I do this trade or not. It's more of a question of what option strategy do I use and how do I optimize it. In other words, I can make money whether the market's going up, down, or sideways. I can make money just on time passing by, like I'm showing you here. I can make money on watching people expect the unexpected, right? I can watch people when they think that something is about to happen, even if it never happens. So we can tune an option to be one-dimensional. So write down these words. We can tune an option to be at parity is the buzzword. We also call it one-dimensional. We also call it to be intrinsic value dominated. We can tune these options. So what I want to do in order to tune my option, I want to buy an option that's going to act just like the stock. So if Caterpillar goes up $1, so will the option. If Caterpillar goes down an option, but I don't want to pay $99.29. What I want to do, it's called going deep in the money, and at the same time I want to go far out in time. For those of you that do have some expertise in options, I'm going for a delta of 1. I'm going for parity. Let's look again at the option series and see if we can't pick one for Caterpillar. So I'm going to go out. And I'm going to go out far. And one of the reasons why I'm going to go out far is because I've been known to trade premium against these leaps and stocks. I think my record now is 14 months in a row. On average, I'm there 7 or 8 months. Every month, just collecting rent. Some of you have heard about buying a house or something and collecting the rents. I buy stock and I rent them out. And every month, I get new tenants and I get to collect a new premium. Does that analogy make sense? If it does, write a yes in there. All right, so I'm going to go out as far as January 2019. It's called a leap. And I'm going to go deep in the money, because when I go deep in the money, this thing starts to act one-dimensionally. No longer is time decay a component. No longer is the buying and selling pressure going to affect the price. You notice when I clicked over here and I looked at all the options, not just the ones closest to the expiration date, there's a lot of options against that one stock, even out here in the month of January 2019. So let's go deep in the money. How about we go as far back as $60 strike? Caterpillar's trading right now at $100. We're going to go all the way down to 60. We could go down even further. But you'll notice right away that this thing is trading somewhere between 38.60 and 41.05. I would put a limit order out there for maybe $39 and maybe $40. $39.80. So now when you start to think about that, and there's some economics in there and some money management that I can talk about, but I'm at the end of my time, so let me kind of button things up here. But if you think about it, I'm now buying my underlying symbol at about $39.80 is what I'm putting it out there. And I'm still making that 91-cent premium. Let's do the math. The cost basis now becomes $38.89. If I get called out of this thing at the $100 strike price, I am going to have to put the difference. So that means basically the $100 difference from the $60 call is $40. So I'm going to get $40 for $38.89 of investment. So $40, oops, I'm going to be in the calculator app. 40 minus $38.89, I'll get $1.11 of profit. $1.11 of profit over $38.89. Now we've already bumped ourselves up from whatever we were before. Now we're at 2.9%. Time this the way we were going to time the other one. And because we're dealing with a symbol that are a price that's about a third of the price of the underlying symbol, that means that when we time it, instead of a multiplier of 2 or 3 on the returns, it winds up being a multiplier of 6 to 12. It's a multiplier of 3 times whatever it was, because this is a third of the price. I know I'm throwing these numbers out there and you're saying, what? But it does work out that way because this is 1/3 of the price of the stock. That means that when we time it, if on the stock we were able to increase our returns by a factor of 2 or 3, now we're talking about a factor of 6 to 12 or 6 to 9. So now we're up to well into the double digits of return. And this is what a lot of the folks at the 6% protocol are doing month in and month out. And they're picking about 3 or 4 candidates, because when you do the risk graph on this, you can come with a risk where should all hell break loose on your trade and you have to get out taking the worst loss possible, we can do position sizing such that that worst loss possible is not going to affect our portfolio by any more than 2%, which is a digestible loss. And so by using our position management, losses are capped at 2%. We time our positions into the leaps, and we target that 6% protocol, but we're making closer to 10 to 15% every month. And it works out very well. And I can stay on and answer any kind of questions for people that are interested. But I think, do you get the general gist? How many of you with a yes get the general gist of what we're doing here? Kind of like a covered call on steroids. It's actually a long debit spread substituting in for that expensive stock with a less expensive, far out in time, deep in the money leap call. Very cool. Using these 10 tests, find your underlying candidate that's going to work best. And then I ask for you to just paper trade this strategy. Test it. See if I'm full of crap, but I'm not. I've been doing this since 2006, this exact strategy. One last piece. If you remember that drawing I showed you, if I can find it. I got a lot of windows open. There it is. If you remember this drawing that I showed you, you might say, well, what if the stock tanks? Now that we've got a lot of extra profit in there, because we've been lowering our cost basis, it makes sense that we might want to, especially when we determine that the risk is high, limit our risk by using what's called a protective put. It's a form of insurance. So let me just summarize this for you here. And I won't waste your time explaining why you pick what, but we're going to use a deep in the money, far out in time leap call, leap, and then we're going to use an at the money near term call for selling. We're going to go long on this deep in the money far out in time call leap. We're going to go short as step 2. And then finally, we're going to protect ourselves by going long a put option slightly out of the money. So for instance, I might put a put option at $95. The put option would start kicking in if Caterpillar dove down below $95. And I would use this put option a month or two out. So maybe a June or July or August put option. And the reason is because when you get more in tune with this strategy, you'll only use the put option when you have an indicator of risk. And so by going a month or two out, when the risk has passed, say for instance, Fran was talking about earnings in the chat box. When the risk has passed, we'll then go back and sell the put. We only need the put when we fear, when we have the risk. So by going a month or two out, we'll get a good sale price. So it won't be a complete loss. We'll be able to resell our insurance policy and not have to just eat it. Makes sense? Now, somebody asked, does my screeners do all of this for you? The combination of my screeners in the 6% protocol and then the combination of what I teach you absolutely does all of this. So if you wanted to actually come and do this strategy with the rest of my group, we'd love to have you. I have a little website for you. 6pp.today/cyber2. I'm going to put that right into the chat box for you, so you don't have to just copy it down. You can click on it. Can everybody see that in the chat box? If you can, give me a little yes. 6pp.today/cyber2. And while I'm here, I'm going to go ahead and click on that. And I'll show you what you get. And then I'll open it up for questions. Or actually, what I'll do, I'll come over here and I'll simply type that web address here. So 6pp.today/cyber2. So you'll come to a page where yours truly will talk to you. You can pause him. It always makes me laugh when I listen to myself. You can listen to Jay over here and Jen and Steve. They talk about this. You can take a look at some of the positions that we have in our current portfolio. Read a little bit about it. See exactly what you get. You get the screener with what positions to enter. You can also get the one click into figuring out all the analysis that you need. And we have a once a month live webinar. We also have a way for you to get me to work with you on your trades at no cost. Everybody has equal access to me through a insight. I'll actually show you. I'm that excited about this. So you can come over here to the Learning Center, to the Community Forum. Is it here? I have so many windows open. There we go. And you can send me a message through our community forum. And the reason why you want to do this is because none of my assistants will be checking these, and neither will my spam filters. Your message comes directly to me. And so that gives me the ability to talk with you directly, because I give priority to the folks working in the program, if that makes sense. All right, so almost there. I'm also going to send you the DVD of education. And I'm going to let you be part of this for 6 months. And here's the discounted price for Fausto's group. $497, 6 months of unlimited access. And here's my guarantee, because I know how well this works. I want you to try it for the 6 months. And if you follow those instructions, use the system, and at the end of 6 months you haven't earned your profits yet, not only am I going to give you your money back, but I'm going to take another $497 out of my pocket and add to it. It's called a double your money back guarantee, and that's because I know it works. And there is actually, if you know about this and you know how well this strategy works and you like the screener and you want to get some of my tidbits, we have quite a few people that just sign up for 3 years. We have a 3-year upgrade. So instead of $497, going to be $1497, savings of $1,485, and you'll be working with me for 3 years. If you're serious about making your nest egg and all of that good stuff like we talked about in the beginning, this is the way to do it. So with that said, I'm here for questions. If you've got some questions, go ahead and type it into the general chat area. I hope to see all of you visiting me here at this 6bp.today at Cyber 2. Check it out. Let me just ask, with a little yes or no in the general chat, how many with a yes or no learned something new today that you had never learned before? I'm just curious. Awesome. Quite a few yeses. Okay, then riddle me this. How many of you with a yes or no, you maybe knew about this stuff, but now you know better how to do it, how to use it, how to test for it, how to apply it? Awesome. And how about this question? Did you have fun this afternoon? I always like to know how my educating goes, because I like to pretend like I'm a good teacher. Did I talk at a good enough rate, or was I too fast, too slow, too boring? I did get a question over here. Can you go over the divide of the channel width over the price average? Yes, absolutely. So I'm going to quickly jump over here to our notepad. This was one of the 10 tests that I quickly evaluate to make sure that I've got a good candidate to do this 6% protocol variant on. It was number 9, and it's calculating the channel width divided by the average channel price. So let's use a different candidate than Cat, and we'll do it all over again just so that we can really solidify that home for ourselves. Let's come over here, and we'll come on back to our charting. Here's a candidate that I was looking at just last night with the traders. It's a lower priced candidate, MDRX. Makes it more affordable when it's lower in price. Wait a second for it to load with the charts. There we go. So MDRX, we were playing around with a level of support at roughly $11.50 and another one at $12.50. And we double checked that by looking at it on our point and figure chart. So we're going to come down here and we're going to look at the MDRX and see if that 1150 and 1250 numbers play through. So as you can see here at 1150, we have quite a lot of trading that happened there, and the reversals since the middle of 2014. Remember, they put the months and the years, these 11, 12, 13, 14, 15, as reference for us, but time is not the increment here. You'll notice a little bit different than the Caterpillar. This particular candidate has been in the same range for years, which makes it very exciting for the 6% protocol. So $11.50 has been a nice level for us of support. And it also, if we come down here, $10 or $9.50 has also been a level that we've never, over the last almost 6 years, almost 7 years, hasn't gone below. So that could be our drop dead price where we would bail, and should it go that low, if it hasn't gone that low in years, that's when we would say, okay, that's our insurance policy. So we don't have to let this trade, bankrupt us all the way down to zero. We know if it goes down below $9.50 that we should bail the heck out. So that gives us a lot of comfort with this particular stock. Let's go back to our regular price and volume chart. So we were saying $9.50. We could even be a little bit more conservative, and we can, here I'll show you a year chart or a 2-year chart. I mean, even in the last 2 years, $10 has been our bottom. Going to limit our risk pretty strictly here. But that wasn't the question. The question was, how do I evaluate channel width over average channel price? So let's do it here. Talking about 1150, 1250. What's our channel width? The channel width is $1. Did you guys get that answer? Now let's do the average channel price. 1150 plus 1250 divided by 2. The average channel price here, which means the price right in the middle, is $12. So now we create a ratio. $1, that's the channel width, divided by $12, the average channel price. 8.3%. Like I said, I'd rather it be between 10 and 20. Anything below 10 gives me a little bit of uncertainty. If it's below 5, I won't touch it with a 10-foot pole. 8.3 is better than what we calculated on Caterpillar. And I would definitely take this with the other 9 tests. I wouldn't just do this test all alone, but this is one of my favorite tests to do. Hope that answered your question. Do we have any other questions? If you have a question that you're got on your mind, go ahead and type that in. And if not, I think we might wind ourselves down. Doesn't look like I've got any other questions forming in here, so I think it's time that we type ourselves down. Let me go ahead and one more time give you that web address. Who's interested, just out of curiosity, of actually being part of this 6% protocol experiment program with us? Just type a yes or no inside of that general chat area. Fantastic. If you have any sort of questions that you think of outside of this, I want you to definitely communicate with me. So if you have any sort of questions whatsoever, my email address is really easy to remember because it's easy to spell my name. I'll put it on our notepad here. aj@tradingtrainer.com. I'll put it into the chat area as well. aj@tradingtrainer.com. Feel free to start a communication with me. And one last time, I'll put it into the chat area, and then I'll hand this over to Eric and call it a day. 6pp.today/cyber2. All right. That's everything. Let me just check. Eric, am I the one who closes us down? Or do you come in and say goodbye? Thank you, Charlie R. I think I'm the one who's going to close us down, so I really appreciate every single last one of you. And have a good rest of your Tuesday. Take care.